Statistics show that 6 out of 10 Canadians worry about running out of money in retirement. It's easy to understand why. Costs keep going up and interest rates change a lot. If you've ever stayed up at night thinking, what if I live to 90, but my money only lasts until 80? This video is for you. If you feel anxious about this, it doesn't mean you are in trouble. It just means you are normal, and having a plan can help. This video will help you understand the main risks and show you 3 simple ways to take back control. When people talk about retirement risk, they often focus on factors such as stock market crashes and inflation. Those are important, but there's an even bigger challenge: longevity risk. That's the risk of living a long life, but your money won't last as long. The good news is that there are 3 big levers you can adjust to attack that problem from different angles. First, spend smarter. Second, invest more safely as you approach and enter retirement. And third, focus on building income that lasts for life. Let's go through each one in simple terms. Number 1, spend smarter. Most people think of retirement as needing one big number each year. Here is a trick for you. Break your spending budget into 2 levels. A baseline budget, your normal lifestyle in retirement. This includes your essentials, housing, groceries, utilities, and insurance. And a premium budget. These are your regular nice things like travel, eating out, hobbies, and gifts. A lean budget is the bare minimum version you could switch to for a while if markets drop or your investments have a bad year. You still pay for essentials, but you cut back on extras to ride out the storm. Having 2 budgets is powerful because it gives you a built-in plan B. If markets drop early in retirement, you don't have to panic or sell investments at a bad time. You can switch to your lean budget for a year or 2, wait for things to improve, and then return to your baseline budget. This flexibility can make it much more likely that your money will last as long as you do. Number 2, invest more safely near retirement. Many Canadians keep most of their money in stocks right up to retirement because that's how they grew their savings. But there's a risk called sequence of returns risk. This means that if the market crashes in your first few years of retirement while you're taking money out, it can hurt your finances much more than a crash that happens later. It's like descending from the mountain peak. If you slip near the top, you won't recover easily. It's much more dangerous than slipping near the bottom. In retirement, those first 5 to 10 years are like being near the top. To lower this risk, you can gradually shift to a more balanced mix as you approach retirement. Instead of having 90 to 100% in stocks, you might shift to a mix of stocks, income ETFs, bonds, GICs, and cash. Keep a few years of essential expenses in safer, low-risk investments. That way, if markets drop, you can use that safer money for a while. This doesn't mean you should have no stocks at all. You still need growth to keep up with inflation during a retirement that could last 25 to 30 years. The key is to balance safety so you're not forced to sell in a crash with enough growth to keep your money working. Here are some examples for each age group, assuming a person living to the age of 99. Retirees in their 60s typically favor a 40 to 60% stocks to combat inflation over 25-year horizon, paired with 30 to 40% in bonds or income ETFs for income, and round up with cash holds 5 to 10% for 2 to 3 years of expenses to avoid selling stocks in downturns. An example of asset class allocation for folks in 60s would be stocks 50%, growth to outpace inflation, bonds and income ETF 40% for stable income, cash or GIC 10% for liquidity. As you moved into the 70s, allocations tilted conservative, with 30 to 50% in stocks, 40 to 50% in bonds or income ETFs amid rising longevity risk. Cash should rise to 10 to 15% for immediate needs, favoring GIC ladders in Canada for CDIC protection up to $100,000 per issuer. An example of asset class allocation when you hit 70s would be stocks 40% modest growth, bonds or income ETF 45% for principal protection, cash at 15% as an emergency buffer. For those in their 80s, 20 to 40% in stocks suffices for mild growth, with 50 to 60% in bonds, GICs, to minimize volatility. Cash at 15 to 20% offers spending flexibility, often in money market funds or one-year GICs. An example of asset allocation for retirees in their 80s would be stocks 30% as inflation hedge, bonds GICs 55% for income stability, cash 15% as near-term security. In our last tier, for folks in their 90s, prioritize preservation with 10 to 30% stocks, 50 to 60% bonds or GICs, and 20 to 30% cash to cover healthcare or legacy goals. GICs and short-term bonds dominate for predictability as equity volatility becomes intolerable. An example of asset class percentage would be stocks 20% with minimal growth, bonds GICs 55% for guaranteed returns, cash 25% to provide maximum liquidity. Of course, everyone has a different goal and lifestyle. I hope these templates give you a starting point for building your own plan. Finally, let's get in our final lever for today: build more guaranteed income. In retirement, you can think of your income as coming from two sources: income that can run out, like withdrawals from your investments, and income that cannot run out as long as you're alive, such as certain pensions and government programs. In Canada, the main sources of lifetime or very stable income are CPP, old age security, defined benefit pensions from some employers, life annuities from insurance companies. CPP is a government pension that pays you a monthly benefit for life. It's also adjusted over time to keep up with inflation. One key option many people overlook is delaying CPP. If you wait past age 65, your CPP payment increases each month you delay, up to age 70. That can mean a much higher guaranteed payment for the rest of your life. OAS is another government benefit that starts for most people at 65 and also has inflation protection. Between CPP and OAS, many Canadians get a meaningful chunk of their basic retirement income from these two programs. If you're lucky enough to have a defined benefit pension, that's like a personal paycheck that continues for life, and in some plans, it's partially indexed to inflation. That means your payment can rise over time to reflect the cost of living. Then there are life annuities. With an annuity, you give an insurance company a lump sum, and they promise to pay you a guaranteed income for as long as you live. It doesn't matter what the stock market does, the payment keeps coming. It's similar to buying your own mini pension with part of your savings. The goal with all of these is to build an income floor, which means having enough guaranteed income to cover your essential expenses like housing, food, basic transportation, utilities, and healthcare. When you know your essentials are covered by income that can't run out, it takes a lot of pressure off your investments and your peace of mind. Let's pull this all together with a simple example. Susan is 63. She lives in Ontario. Her mortgage is almost paid off, and she has about $650,000 in RRSP and TFSA. She's expecting CPP and OAS, as well as a small workplace pension. She keeps hearing that she needs at least $1 million or more to retire, and she's terrified she'll run out of money if she lives into her 90s. Here's what she does. First, she writes out her baseline budget, about $55,000 a year after tax. That includes some travel and hobbies. Then she creates a lean budget of about $45,000 that she could switch to temporarily if markets crash or things get tight. Second, she adjusts her investments. Instead of being heavily in stocks, she moves enough into safer investments, cash, GICs, income ETF, and bonds to cover several years of essential expenses. The rest stays in a diversified mix of stocks and bonds, so she still has growth potential. Third, she works with a professional to boost her guaranteed income. They decide she'll delay CPP to age 70, which increases her lifelong monthly CPP payment. They also use a portion of her RRSP to buy a small life annuity that provides her with another guaranteed monthly payment on top of CPP, OAS, and her pension. After this, Susan has an income floor that covers her lean budget with guaranteed sources of income. Her investments still matter, but they're no longer the only thing keeping her from running out of money. This shift from relying only on the markets to having several lifetime income streams is what helps her sleep at night. This doesn't mean everyone should delay CPP or buy an annuity. The main idea is that using these three levers together, spending flexibility, safer investing near retirement, and more guaranteed income, can turn a vague fear into a clear plan. Here are 3 quick actions you can take if you're within about 10 to 15 years of retirement. First, map your essential versus optional expenses. Grab a piece of paper or a spreadsheet. Make 2 columns. Essentials: housing, food, utilities, basic transportation, insurance, and medication. Optional: travel, dining out, hobbies, gifts, home upgrades. Add up each column to determine your minimum income floor and your ideal lifestyle. Second, list all your income sources. Write down what you expect from CPP, OAS, any workplace pensions, registered accounts like RRSPs, non-registered investments, and possible part-time work. If you haven't already, log into your online government account to see your personalized CPP estimate and explore how starting earlier or later would change your payment. Third, get help if you're within 10 years of retirement. If you're 10 years or less from your target retirement age, consider meeting with a qualified financial planner. A professional can help you pick a sensible investment mix for your stage of life, decide when to start CPP and OAS, and explore whether using part of your savings for an annuity or adjusting your pension options makes sense for you. The goal isn't to be perfect. It's to move from "I have no idea" to "I have a rough plan and I know my options." Even that can make a big difference in reducing your stress. If you learned something today, or if this helped calm some of your retirement anxiety, hit like and share this with a friend or family member who's worried about the same thing. Remember, ignoring the fear of running out of money won't make it go away. It gets smaller when you understand your spending, invest in a way that fits your age, and build enough guaranteed income to cover your essentials. In the next video, we're going to go deeper into CPP, how much you can expect, how delaying actually works, and how to fit it into your overall retirement income plan. So make sure you subscribe and turn on notifications so you don't miss it. Thanks for watching. Start working on your own plan tonight.